Welcome to this Inflation in the Aftermath of COVID-19. Was it inevitable or unavoidable webinar? First of all, I must say thank you very much for joining this webinar in the middle of typhoon signal number 8 in Hong Kong. Well, the subject today is, of course, to many of us who are monitoring economic developments or financial market developments, is a very timely and important subject. For those of you who have gone through a long period of what is called the era of great moderation, when inflation has been low, interest rates has been almost zero, economic growth is reasonable, that was a golden era. But then suddenly, inflation is coming back in a much stronger way, in a much more sustainable way than many initially thought. Initially, people wonder whether it's because of the pandemic, the impact of the pandemic on labor supply, on lockdowns, on supply chain disruptions, or is it because of the war in Ukraine leading to higher energy and food prices, and with all the secondary or third round impacts on other prices? Or is it fiscal stimulation by many governments in an effort to help the population to go through all these difficult economic times? So there was a time when people were debating whether this sudden surge in inflation is demand pulled, driven by too much fiscal stimulation, or is it supply driven because of all these surge in energy prices and food prices and supply chain disruptions, geopolitical problems, and so forth. And then the problem gradually evolved because central banks have been catching up in terms of the need to contain inflation. The market begins to wonder how far are the central banks willing to go, bearing in mind, first of all, the need to catch up, not falling behind the curve, so to speak. But then central banks are also aware that after such a long time of zero interest rates, leverage in the financial system, in many parts of the financial system, have been built up, and if interest rate increases suddenly comes in a very rapid and continuous way, there could be financial stability concerns. Witness the recent problems in the UK gilt market. Of course, there are also employment and economic growth concerns, and central banks have to bear in mind how far do they need to go to suppress inflation while not hurting employment too much. So effectively, all these mean that the trajectory of inflation is a very important subject, because inflation will affect what central banks do. And the more uncertainties there are in inflation, the more uncertainties there will be on the interest rate expectations, what central banks will do. And all these uncertainties will add up, and then it leads to even more financial market volatility. So this is a very important subject at this juncture. Today, we are very happy to have Dr. John Greenwood with us, who will share with us his views or an analysis of the current inflation situation. Based in London, John is the founder and chief economist of International Monetary Monitor Limited, a macroeconomic consultant firm. John started his career in 1970 as a visiting research fellow at the Bank of Japan. In 1974, he joined GT Management as chief economist, based initially in Hong Kong and later in San Francisco. The firm was acquired by Invesco in 1998, and John became chief economist with responsibility for providing economic analysis and forecasts to Invesco portfolio managers and clients until he retired in 2021. As editor of Asian Monetary Monitor in 1983, John proposed a currency board scheme for stabilizing the Hong Kong dollar. He later served as a member of the Committee on Currency Board Operations of the Hong Kong Monetary Authority since 1998. John was a director of the Hong Kong Futures Exchange Clearing Corporation from 1987 to 1991. And he was also a council member of the Stock Exchange of Hong Kong in 1992. In the UK, John is a member of the Shadow Monetary Policy Committee in England, and he serves on the board of the Hong Kong Association in London. Most central banks and forecasters, as I've mentioned earlier on, were surprised by how much higher and how much more sustained inflation has been. But John is one of the very few economists who have successfully forecasted the rise in US, Eurozone, and UK inflation recently. Today is a good opportunity to listen to John's analysis and wisdom. John will give a presentation of around 45 minutes to an hour, and then we'll have about half an hour for questions and answers. Please feel free to raise your question through the Q&A box. Now, let's welcome John to give us his presentation. John.
Well, thank you, Casey. And I should also thank Hong Yi Chen for organizing this session and his assistants, Christy and Selena in the background, and for the HKIMR and the Academy of Finance for making this opportunity available for me to speak to you. I'm now going to share my screen because I have some slides to show you. Hopefully now you can see those slides. Casey, everything is all right? Good. Okay. So as Casey mentioned, very early on in the COVID episode, we could tell that we were going to have, that is a group of us, a small group of us in the UK, we could tell that there was going to be a significant inflation. And the puzzle really is why central banks and the big consensus of economists simply, first of all, got the analysis wrong, saying that inflation was going to be transitory. And even today, still don't really understand what has brought about the inflation. Now, one thing that Casey didn't mention when he introduced me is that I teach at 3 different universities. I teach at the University of Cardiff, sometimes at Edinburgh, and also regularly at Johns Hopkins. And I always get my students to repeat after me the statement from Milton Friedman at the bottom of this page on the slide. And this is going to be the theme of my talk. Monetary policy is not about interest rates. Monetary policy is about the rate of change of the quantity of money. I'm sure that will surprise many of you, because today, after all, everybody is expecting the Fed to raise rates, and the big question is how much they're going to raise rates. Is it going to be 75 basis points or 50 basis points, and so on? And they listen to Bloomberg, CNBC, you read the newspapers, all the commentaries, almost all of it is about interest rates. How far should central banks raise interest rates? But I'm going to show you that I think that that is the wrong question to ask. And that thesis will run all through my analysis. So let's move to the agenda. What I'm going to do is to contrast the experience of 3 higher inflation economies, the US, the UK, and the Eurozone, and their central banks, with 2 lower inflation economies, Japan and China, although I'll have less to say about those. But along the way, I will make a detour to ask the question, why was it that economists failed to predict inflation? And we can discuss that in the Q&A, whether you think there are different reasons or whether I've got it wrong, but I'd certainly be very interested to hear your view. So let's move to the first slide. Now, in my view, there've really only ever been two theories about inflation. The oldest one, going back to the school of Salamanca in Spain in the 15th and 16th centuries, is the monetary explanation of inflation. That is, that there is an excess growth or a rapid growth of money relative to output or real GDP nowadays, and money demand, the demand for money. And that, of course, was very famously summarized by Milton Friedman in his statement that inflation is always and everywhere a monetary phenomenon, in the sense that it is and can only be produced by a more rapid increase in the quantity of money than in output. That statement needs a little bit of refinement, but basically that is correct. Instead of that, what we're getting from the central banks, from the politicians, from the investment banks, from the commentators in newspapers and so on, is a whole lot of what I would call ad hoc explanations. As Casey mentioned, people have said that reopening after COVID led to supply chain disruptions. There had been shifts in the demand from services to goods, and that created all kinds of supply problems. People then blamed fiscal expansion and the handouts by government for the inflation. That's particularly the thesis of people like Larry Summers and Jason Furman. More recently, energy prices have risen strongly, and people have blamed that partly on the frictions between Russia and Europe, and also on the war in Ukraine. But at other times, people blame union pressures, wage price spirals, deglobalization, and so on. So there's a whole range of explanations. And I just want to illustrate that very quickly with three quotations from leading central bankers. So when he was interviewed last February of last year by Congress, he had to give testimony. Jerome Powell, speaking for the Fed, was asked, well, what about this huge increase in money which has occurred? And he said, well, right now, as you can see, as I've highlighted or put in bold, right now, M2 does not really have any important implications. And this is an astonishing statement to a monetary economist like me, because I don't know of any inflation which has not been preceded by rapid money growth. So to say that it doesn't matter is the most bizarre statement to come from a central bank, in my opinion. Andrew Bailey is not much different. Here's another attempt to blame others. He says, we are helpless in the face of inflation. 80% of inflation is due to a sequence of external shocks, such as the pandemic and the war in Ukraine, creating a terms of trade shock for energy and food. In other words, it wasn't really our fault. He's setting the stage to say, we didn't have anything to do with this. And then here's something from Christine Lagarde as late as December last year, saying, inflation is a passing hump, has likely peaked and will decline in 2022. Well, passing hump, I suppose, is Euro speak for transitory. She also went on to say the ECB is very unlikely to raise interest rates next year. That is, in this current year, 2022. So you can see how wrong all of these statements have been. And the puzzle is, who on earth is advising? There are 400 PhDs employed by the Fed, 400 PhD economists. None of them got it right. The Bank of England if you look at a series of their forecasts, they've consistently under-forecast inflation. and so has the ECB. So let's see what actually happened and see if this provides us with a better interpretation. First thing I want you to observe in this chart is the close relationship between money and nominal GDP between 2010 and 2019, that is pre-COVID. Now, this is part of a much longer relationship. I don't have time to explain it in much detail, but basically the world has a problem, or the economics profession has a problem, because most people study the US, and US velocity had a behavior in the 70s, 80s, and 90s, which was quite different from the normal behavior in other countries. I have, and some colleagues have recently completed a study of 89 different economies. And what we find is that the income the income velocity relationship, that is the ratio of nominal GDP to money, is very stable on a downward trend, with a median annual decline of about 1.7% for developed economies and about 2.8 or 2.9% for emerging economies. And that is very stable across the whole world. What it means is that as people get richer, they tend to hold more financial assets, and money is part of those financial assets. And incidentally, what that also means is that you should never look at M0 or M1, you should look at broad money, because we're talking about money as part of people's total portfolio. And if you use narrower concepts of money, you will make mistakes. In any case, when COVID struck in February, March of 2020, you can see what happened. Nominal GDP fell abruptly, mainly because of falls in real GDP, but the inflation component was also very weak initially. And then it began to recover. On the other side, money growth accelerated very sharply. And cumulatively, to date, it has US money supply, M2, has increased by 40% since February 2020. Now, by my calculations, the ideal rate of money growth for the US is to hit the 2% inflation target is about 5 or 6%. So essentially, we've had nearly 8 years of money growth in the space of 2.5 years. This is outrageous and was inevitably going to produce a major episode of inflation. You can ask, why did they do it? And in a superficial way, I think one answer is that when they did QE after the GFC, after the global financial crisis of 2008, 2009, QE did not produce inflation. As you can see at the left-hand side of the chart, the nominal GDP didn't grow at a more than normal rate, didn't grow particularly rapidly because money growth was under control. The reason that we didn't have very rapid, broad money growth because of QE at that time was that the balance sheets of the banks were impaired, and banks were having to deal with loan losses and securities losses and recapitalize. And if you are, as a bank, if you're recapitalizing and making those kind of adjustments, it's not possible to grow your balance sheet very rapidly. In addition, there were new regulations under Dodd-Frank and Basel II and Basel III, all of which restrained, or they increased bank capital ratios, they increased liquidity requirements, and they reduced leverage ratios. So all of that restrained money growth, but it also meant that while the Fed was doing QE, initially the bank's loans were actually declining. Between 2008 and 2011, bank loans declined by almost $1 trillion. That was 14%. If the Fed had not done QE, if it had not injected new money into the system, then overall money deposit growth would have declined by something like 14%, and we would have had something comparable to a repeat of the Great Depression when in 1931 to 33, when US money growth declined by over 30%. So I think what happened, at least in one sense, was that the central banks thought, we did QE last time around and it didn't produce inflation, we can do it again this time. But this time under COVID, the banks were in good shape and they've been continuing to lend, although not particularly aggressively. And so the Fed injections and the injections of other central banks this time has simply added more money onto a system where money growth was already adequate. The next question we have to ask really is, how did these two lines converge, or how is the previous relationship between money and nominal GDP going to be restored? And you can see in the chart that I've projected money as a horizontal line, i.e. zero growth from here onwards, and nominal GDP to close the gap by the end of 2024. Now, of course, you can make other assumptions, and I'll show you one in a moment. But just on that basis, on that set of assumptions, nominal GDP will grow at something like 8%. And since the US economy is only capable of growing at 2%, we know straight away that, roughly speaking, we're going to have 6% inflation for the next couple of years. In other words, we knew straight away, and we've known for a long time, that inflation would be persistent, not transitory. So it's not going to disappear in 23, it will roll over and continue into 24 because of the magnitude of the increase in money and the time lags between those excess money balances reaching people's portfolios and being spent. If you make another set of assumptions about money growing more rapidly, move forward like this, and you have slightly different date of convergence, you can come up with higher nominal GDP assumptions. So I don't want to be dogmatic. All I want to say is that it is absolutely clear from the data that we are going to have inflation all of the way through 2023. It's not going to disappear in the spring of 2023. And it's going to continue likely into 2024. It's interesting to look at the money growth rates over different periods. If you look at the table on the left of this chart, between 2010 and 2019, the average rate of growth of money was just below 6%. And that generated a rate of growth of nominal GDP of 4%, the difference being the accumulation of money balances by American money holders, households and corporate and firms. During the COVID period, 2020 to the second quarter of 2022, the rate of growth of money accelerated by 3 times, almost to 18%. But nominal GDP having fallen and then risen more rapidly, also averaged only an annualized rate of 4%. If we project money growth as in this chart at 5.5% per annum, we have to have 10% nominal GDP growth in order to restore the previous relationship. That's the basis of these kind of computations. So you may not be familiar with these raw numbers looking at the levels. I've also drawn the chart in this format in rate of change form. And here again, you can see the stable rate of growth of money during the period, the pre-COVID period. and alongside it, the stable growth of nominal GDP. So I would say that the low inflation achieved in the post-GFC period had nothing to do with the Fed's average inflation targeting regime. It was an accident of Dodd-Frank, Basel III, and other regulations really controlling and managing the rate of growth of bank balance sheets in the US. And then we have this huge surge subsequently, because the Fed never looks at the money supply. And as you saw from that Powell testimony that I gave, I showed you earlier, he doesn't believe in it anyway. And he would be getting that advice from his teams of economists. So we had this enormous surge in money growth, and then you can make your own assumptions about what you think will happen in the subsequent period, that is after the second vertical line of that chart. But the point is that because that surge was so big, the spillover will persist well through 2023 and probably well into 2024. So the image I want you to have in your mind when you're thinking about this is one from one of my favorite artists, the Japanese woodblock artist Hokusai. He drew this woodblock print, he made this woodblock printing, woodblock print in 1835. And it's called The Big Wave of Kanagawa. And it's basically a tsunami. You can see that that's quite a similar shape to what happened to M2 in the United States. And essentially what we are seeing now is that all that water is washing over the shoreline. And until that has dissipated, inflation will be with us, because real growth can only absorb 2% of that money growth per annum. It's not surprising then that in this picture, the fishermen, who are perhaps you could say they are a metaphor for the modern day pensioner or saver, are frightened and cowering in their canoes at the prospect of this huge inflationary wave which is about to overcome them. Now let me bring you up to date, because actually it's worse than what I've told you, because not only did we have the Fed putting its foot hard on the accelerator between 2020 and 2022, averaging 17.8%, as you see in the top left-hand box over that period. But subsequently, since the start of this year, money growth has come to a complete stop. And in fact, in the period April to September, so the latest 6-month annualized rate is negative 2.2%, and it's zero since December last year. I do not know of a period in the entire post-war history of the United States when we've had such a sudden stop in money growth, which has been extended for such a long period of time. In other words, having put its foot too hard on the accelerator, the Fed has now slammed its foot too hard on the brake. And what that means is that since money impacts asset prices first, in the economy next, and only eventually inflation, we've got to go through a further sharp fall in asset prices and further damage to the economy and higher unemployment before the effects come through in lower inflation. Well, the title for this talk was it inevitable? Was there an alternative? I think there was an alternative. Clearly, I think if they'd been paying attention to money, they wouldn't have allowed that sort of thing to happen. Now, in the old days, central banks did pay attention to money. And in fact, one of the main raison d'etre for central banks was that they could calm a panic. And there is this classic quotation from one of the directors of the Bank of England. He was a member of the court of the Bank of England, as they call it, Jeremiah Harman, giving testimony following the 1825 panic, when he said, he was asked, what did the Bank of England do? He said, by every possible means, and in modes we had never adopted before, we took in stock, that is government securities, as security, as collateral. We purchased exchequer bills, T-bills. We made advances on exchequer bills. We made loans against T-bills. We not only discounted outright, but we made advances, loans on deposit of bills of exchange, on commercial paper, to an immense amount. In short, by every possible means consistent with the safety of the bank. And we were not, upon some occasions, over nice. In other words, we didn't distinguish too much about the quality of the collateral. We didn't mind about that. The important point was to get money into the hands of the people, and that's what they did. So why couldn't the central banks operate in that way? Because that has many, many advantages. Basically, the money is provided during the panic, and then it's withdrawn. And we did have a panic in March of 2020. There was this dash for cash, a dash for safe securities, and the central banks had reasonable grounds to provide funds. But the right way to do it would have been to do the following. They should have done repos, which are self-extinguishing and of limited duration normally. They could have purchased T-bills, which again would run off in a limited period of time. Any kind of short-term lending against collateral would have been adequate. That's in contrast to, say, the ECB's LTROs, the long-term refinancing operations. The common feature of all of those things is that they're self-liquidating after a short period. Instead of that, the central banks stepped in, bought long-term securities, which created money because they purchased them from non-banks. And that money is still in the system, which incidentally creates a big problem when it comes to QT or the removal of those funds down the line, or as is starting to happen already in the US and in the UK. I want to emphasize that everything I've talked about so far has not mentioned interest rates at all. And yet, modern economic analysis is almost entirely focused on R star and the appropriate interest rate level, the normal or neutral interest rate level. I think that analysis is almost entirely useless for reasons which I will show you in a moment. But if you want to use that kind of analysis, you can do so in the following way. You can say, to end the inflation that we had in the 70s and 80s, that the US had in the 70s and 80s, required positive real interest rates, or 2 extended periods of positive real interest rates, and 4 recessions, the back-to-back recessions of 1980 and 81-82, then the 91 recession and the 2001 recession. If you think about it in those terms, you have to ask, well, where are we now in relation to that? And clearly, we still have deeply negative real interest rates, not positive rates. So on that analysis, which I think is wrong, you would say that interest rates need to rise a lot further. But I think that's very doubtful, and we can discuss that in the Q&A. I prefer to stick with money growth. And if you want this kind of analysis, you can deflate money by the CPI. And this gives you a very interesting view, because what it shows you is that every time in the 70s and 80s and into the 90s, every time money growth deflated by the CPI went negative, money growth minus the rate of growth of consumer price inflation, if you like, that's indicated by the blue arrows. And where are we now? Well, you can see we're again deeply in negative territory. I should say that the recession of 2001-2 and the recession of the GFC were not really monetary contractions or I think you could argue about the 2001 episode, but the GFC was a debt crisis rather than a monetary crisis. But again, that's not really for today's discussion. So monetary analysis, focusing on the quantity of money, has provided a very good explanation of why we've had this inflation, and it gave us 2 years lead time in terms of forecasting it. And you can see my forecasts in places like the Wall Street Journal and some of my publications. Now, what I've said is not unique to the US. If you take rates of growth of broad money for the US, the UK, the Eurozone, and Canada, what I've done here is to smooth them. I've taken a 6-quarter moving average or 18 months moving average for money and 6-quarter moving averages for nominal GDP. And what you see is that in general terms, because of that relationship with of the income velocity that I mentioned earlier, money growth in effect creates a ceiling for nominal GDP. So if you've got low and stable money growth, you know that you're not going to have inflation. But look what the central banks allowed to happen in the last 2.5 years. So, but the magnitude varies a lot. The US had the greatest monetary expansion. On this chart, next came the UK, then the Eurozone, Canada, Australia, and New Zealand are similar. But one that I've left out because it's small and it hasn't got a high profile is Israel, which also had a very rapid money growth. I mentioned just now that the US had 40% money growth cumulatively. In the UK, it was 26%. It's 26%. In the Eurozone, it's 22%. Now, as I said, there was nothing inevitable about this. It was entirely avoidable. Look what happened in Japan, in China, and in Switzerland. Japan did allow money growth to accelerate, although that is not due to QQE. That is mainly due to the Bank of Japan's lending scheme, copied from the Bank of England's funding for lending. Their QQE, rather like the QE of the European Central Bank, frankly doesn't work because they buy their securities from banks instead of from non-banks. But for the purpose of this analysis, what I want to say to you is that Japan, Switzerland, and China all suffered from exactly the same external shocks, the same terms of trade shocks, the same supply chain disruptions, the same energy price increases, and yet they do not have inflation. Their inflation rates are 2 to 3%. So it is patently absurd for us leading central bankers to say that inflation was not of their making. It clearly was of their making. India is another country that didn't print money. Their price index is much less reliable, has a very heavy weighting on food, and we've recently had a rainy season, monsoon season, which has pushed food prices up sharply. This is comparable perhaps to the swine flu episode in China, which pushed food prices up there in the year or two before COVID. But in general, these countries will not see the same kind of inflation that we've seen in US, UK, Eurozone, or Canada. So let me just digress for a moment here and ask, why is it, how was it that the economics profession failed to predict the inflation? And this is the second major miss of the economics profession. They failed to forecast the global financial crisis, and then they failed to predict this inflation. And I'd put it down to the following things. First, modern neo-Keynesian or new Keynesian macroeconomic analysis omits money. There's no money in their models and no banking system. But the business cycle, in a broad sense, is a monetary process. If you increase the quantity of money rapidly, that impacts asset markets, then real GDP, and then prices. Leaving out money means that, well, Keynesian analysis seldom looks at assets. They just look at the two items on the right-hand side of that flowchart. They're clearly going to get it wrong. Furthermore, they use interest rates, but interest rates are a bad way to assess or manage monetary policy. Interest rates in themselves are not the price of money. They are the price of credit. That is the price of borrowing money for a period of time. So any chart which shows you interest rates on the vertical axis and the quantity of money on the horizontal axis is going to be wrong. And the classic example of this is what all economists learn in class. That is the Keynesian liquidity preference function. As I say, with money on the horizontal axis, interest rates on the vertical axis. And what that chart says is that if you increase the quantity of money, interest rates will go down. Incidentally, you get the same conclusion from monetary conditions indices, which have been widely promoted by several nameless investment banks in recent years. So those indices will get it wrong as well. Now, it is true that if you increase the quantity of money rapidly, interest rates fall temporarily. If you think back to February, March 2020, interest rates fell, both the short-term rate, the Fed dropped its short-term rate, and then bond yields fell until about August of 2020. But then after that, the economy started to recover, the demand for loans started to pick up, and later the demand or the expectations of inflation started rising, and market interest rates started rising. So eventually, with that rapid money growth, interest rates rose. And that's what Fisher said. Countries with high interest rates tend to be those that have had inflation. So it was left to Friedman to say this clearly. The first effect of rapid money growth is to lower rates, but that's only a temporary effect. The second effect and the more permanent effect is to raise them because of inflation. So if you look around the world today and you ask in which countries are interest rates highest, the answer is countries like Venezuela, Turkey, Argentina, and so on. Is that because they've been holding down the quantity of money according to the liquidity preference function theory? On the contrary, it's because they've been increasing the quantity of money very rapidly. So and the reverse is true too. If you ask where interest rates were lowest, it was countries like Switzerland and Japan and the Euro area over the last decade. Why? Not because they were printing money rapidly, but because they kept the money growth down. And as a result, the inflation was low and therefore interest rates were low. So Irving Fisher got this right. Keynes got it wrong. Furthermore, the modern analysis uses the output gap and the Phillips curve a lot. But both of these are what we call reduced form tools, and they essentially link two symptoms of a common cause. Now, the common cause is money growth. If you look at that little flow diagram at the top, money to assets to real GDP to prices. The output gap only looks at real GDP relative to its potential, and then it says if you go above potential, then there's a danger of inflation. But that's got to be wrong because it depends what's happened to money previously. If there hasn't been rapid money growth, there's not going to be inflation. And then the Phillips curve is the same sort of thing, except that it looks at unemployment or employment, which is part of economic activity. And it says, if you have low unemployment, then you're likely to have inflation. But again, you can have very low unemployment as the US and other economies did before COVID, but because money growth had been restrained, and because, well, the same is true of Japan, because money growth was restrained, there wasn't any inflation. So the Phillips curve has turned out to be, as Bill Dudley likes to say, as flat as the plains of Kansas. So these tools of modern Keynesian analysis are frankly useless. The Taylor rule is actually a combination of 2 and 3. So you can guess how useful I find that. Basically, the quotation that I gave you right at the beginning is what is the one to follow. That is, don't use interest rates as your measure of money. Monetary policy is not about interest rates. Monetary policy is about the rate of change of the quantity of money. So let me move on to sort of very briefly, the transmission mechanism, which I've already indicated to you. If you accelerate the rate of growth for a period of time, of money, broad money, for a sustained period of time, the first impact will be on asset prices, the next impact will be on economic activity, and then finally on inflation. The first transition is what we call portfolio rebalancing, and then the wealth effect transfers increased asset prices into more spending, either by firms on investment and hiring or by individuals on consumption and perhaps investment type spending on homes and so on. But that is the way in which those excess money balances get absorbed into the economy and ultimately show up in goods and service prices. And again, we can go through the quotations, but the important point here is that the transmission of faster or slower money growth is mainly through asset prices, not just through the interest rate on new lending. And then the other thing which modern economic analysis tends to ignore is the lags in effect. As I said, we knew pretty much in the early summer of 2020 that there was going to be a significant inflation episode because of the money growth in so many countries. But clearly the central banks did not realize that. For most of that summer, they continued to say that COVID would be a deflationary event, and therefore they justified their big increases in QE, and governments justified their big provisions of spending on the same basis. Let me turn now just very briefly to some of the other countries and some of the other things that are going on. First of all, on the UK, obviously we've had significantly weak sterling, and especially weak during the recent period when the Truss government introduced a mini budget, which they didn't really want to call a budget, and then the markets sold off aggressively. But the yen and the euro have been comparably weak. In the Japanese case, the Bank of Japan shows no sign of deviating from its current zero interest rate policy or yield curve control, YCC, supported with QQE. So from a market point of view, the perceptions of the markets are that the Fed is being tighter than either the Bank of England or the Bank of Japan or the Euro or the ECB. And as long as that is the case, traders are going to borrow these currencies in this chart and do carry trade and invest in high yielding short-term US dollars. And that will continue, in my opinion, until market perceptions shift, possibly in the middle of next year, because by then the US economy will be in the middle of quite a severe downturn, and then the Fed may decide to shift policy. But essentially what we've got is that these, if you flip this chart around, these currencies have been, or the dollar, let's put it in terms of the dollar has been going up steadily and gradually on the escalator. And then when sentiment shifts sometime next year, I think it will fall very sharply. And that will be somewhat comparable to what happened in the aftermath of the Plaza Agreement of September 1985. So foreign currency weakness is largely a result of those kind of pressures. Obviously in the UK, we also had a big sell-off in gilt yields. Here I've compared the 10-year gilt yields, and you can see how 10-year gilt yields initially went, because of that episode, moved above even US 10-year treasury yields, but subsequently they've come back below them. Japanese JGB 10-year yields not moving at all during this period. And this is a chart which simply emphasizes what a disastrous investment bonds have been during this period. Those of us who use monetary analysis figured that at some point there was bound to be a significant rise in rates, and those of us who did that stayed well clear of holding any bonds whatsoever. So a 60-40 portfolio is something, well, that's an investment philosophy that I would never adopt. In asset allocation has to be conditioned on background monetary conditions if you're going to get it right. Now, let me say a word or two about inflation. And these are some general remarks which apply not only to the UK but to other economies as well. In broad terms, if you look across the developed world, in the years before COVID, goods prices were relatively weak. That is, they rose at a rate lower than the overall CPI. And service prices rose more than the overall CPI. If you did this chart for durable goods, the declines would be even greater. Durable goods being mainly manufactured goods, obviously many of them coming from China. So what often people say is that China exported deflation. No, China exported relatively low manufactured goods prices. The inflation rate in each country was determined by money growth in that particular country. So inflation is not only always and everywhere a monetary phenomenon, it's also a local phenomenon, so long as you don't have a fixed exchange rate. And what's interesting about the COVID episode is that the goods prices having been very weak and service prices having been relatively stronger, those two switched around with the lockdown. So with the lockdown, people couldn't go out to restaurants, they couldn't go and have their hair cut, they couldn't travel, they couldn't go to theaters and concerts and so on, and as a result, service prices remained much weaker. And goods prices shot up because we could order things at home and undertake home improvements and so on. What I expect to happen, because this is an episode of overall inflation, is that we will again see a switch with goods prices probably slowing relative to the overall price of the overall CPI level, and service prices in the form of things like wages and prices for travel and hotels and restaurants and so on, rising more rapidly. And that's exactly what we're starting to see in price indices in the US, in the UK, and elsewhere. So initially, the inflation, because of the peculiar circumstances of COVID, initially the inflation was in goods prices, and now it's migrating to service prices. Now, the background to the UK inflation is, as I said, rapid money growth. Here I'm showing it to you in this chart. These are different measures of money. I don't think we need to go into any great detail, but essentially you see that UK money growth peaked at about 15%, and subsequently it has come down to about 5%. Now that's not as severe as the slowdown in the US, and hopefully the Bank of England will keep it at about 5%. But I'm not optimistic about that, because if you look through the Bank of England's quarterly bulletins, or their quarterly inflation reports, which have recently been rebranded monetary policy report, you have to go back to August of 2018 in order to find any mention of money. They've not mentioned money for 4 years. So like the Fed, they don't look at money. Nevertheless, by accident, we've got to a rate of money growth which is about right for the economy. In the Eurozone, they've been slower to raise rates. And again, there's been less abrupt slowdown. But the analysis here that I'm showing you is pretty much what I showed you for the US, and you can make similar projections, and you can kind of come up with some sort of figures about what the Eurozone nominal GDP will be, and therefore what the inflation will be. But I think that's a better way to approach it than many others. The good news for Europe is that if you smooth that rate of growth of M3, the black line, what you find is that it's come down quite a lot. It's down to close to 6% on a smooth basis. And what that suggests in this chart, where it's been moved forward 2 years to account for the lag in effect between money growth and inflation, is that we must be approaching the peak of inflation. And so in 2023, in contrast with the US, there's a better prospect of significant declines in inflation in Europe. Turning to Japan, you've got on this chart, I've put nearly 70 years of Japanese monetary history expressed in terms of the rate of growth of broad money. Now, in the early years, in the 50s and 60s and early 70s, the Japanese economy grew at an average rate of 9% per annum in real terms, and that justified a much higher rate of money growth. In addition, Japanese people were adding to their money balances at a much more rapid rate. It's interesting that in this chart, after the first oil crisis, the money growth rate slowed down, so in the late 70s. So the second oil crisis didn't produce any major inflation in 79, 80, because they controlled money. Whereas in the first oil crisis, they had allowed money growth to be far too rapid, up over 25% even on the smoothed basis. The Japanese bubble shows up as a quite modest increase in money growth from 8% roughly to 12%. But what's really important and interesting for us is that ever since then, money growth rate in Japan has been too low. In fact, it's averaged only 2.5% ever since the early 1990s. Now, Japan, like the UK and the US, probably needs a money growth rate of about 4 or 5% at least in order to hit the 2% target. So the reason why Mr. Kuroda never hit the target until recently was that the money growth rate was too low despite QQE. QQE was not having the effect of increasing the money supply. As I said earlier, the only reason why money growth has accelerated in Japan recently, and now it's come back down again, was the lending scheme by the Bank of Japan. And if we update you on those figures, you can see that the money growth rate has indeed returned to pretty much its pre-COVID average, which very much indicates that the current 2% inflation rate in Japan will only be a flash in the pan. It will not stay at 2% for very long. It'll come down and Japan will be back to the bad old disinflationary days and very low inflation that we've seen for so long. Japan too has had the same sort of surge in goods prices during the pandemic. You can see that from 2020, that goods prices moved up, durable goods prices moved up much more. service prices remain subdued, and because money growth on the whole has been much more subdued, the service prices are not really catching up in the same way that they are either in the US or in the UK. So I would expect durable goods prices, to start to come down sometime next year. And then Japan will be back to, as I say, it's pre-COVID, low equilibrium, or low interest rate, low inflation equilibrium. Finally, let me say a word or two about China, where inflation has also remained very subdued. Two or three interesting observations about China. First of all, China was the only country among the major countries to emerge from the GFC very strongly. And the reason for that was that 4.5 trillion yuan stimulus policy in 2008, 9, 10, which translated into a very rapid growth of money. Other countries had big budget deficits, but money didn't grow for reasons that I explained earlier, because the banks were impaired and having to repair their balance sheets. But in China, the central government encouraged the provinces and municipalities to borrow from the banks, and the banks were encouraged to lend. And the result was we had this big surge in money growth in China. The stock market doubled, property prices went up steeply, the economy recovered, commodity prices were strong, and inflation went from memory something like -1.5% to 6 or 7% in the space of 2 years. So that was a classic inflation. But ever since then, it's very clear that the rate of growth of money has been under control and gradually come down and down. But in contrast to that, debt or credit in China has risen continuously as a percentage of GDP. If I was to superimpose it on this chart, it would go from bottom left to upper right. In other words, money and credit are not the same thing at all. You can have relatively tight money, which China has had, at the same time as you can have a credit bubble. Now that's a very interesting phenomenon, and I can only find one or two other examples of it. But one of the interesting ones is what happened in the United States in the 1920s. If you look at the data in the 1920s, the US did not have rapid money growth, despite the fact that it was the roaring 20s. And much of the 20s, inflation was actually falling, the prices were falling. There was, however, a credit boom. There was leveraging up. There were huge broker loans for people to buy the stock market and to buy real estate, but not much of it came from the banking system. And as a result, as I say, money growth was restrained, but leverage picked up. So when the stock market crashed in October 1929, the US had a major problem, because not only did the credit bubble burst and the amount of credit was drastically reduced, but in addition, money growth slowed down sharply because the Fed didn't do QE. The Fed didn't step in and do anything really to counter the contraction in money. But coming back to China. So China has this problem that they are over-leveraged at the moment, and as you all know from the 3 red lines and all of that, they need to deleverage. Recently, money growth has accelerated from 8% to 12%, which interestingly is very similar to the sort of acceleration that Japan had at the time of the asset bubble in the 1980s. However, in China's case, China is already leveraged, whereas Japan at that time was not leveraged. And Japan at that time had rapid credit growth outside the banking system. So Japan had both a money surge and a credit surge. This time, China is having a little bit of a surge in money, but the pressure on the credit markets, on debt, is to deleverage. So in my opinion, despite this acceleration in money growth, we're not likely to see a major upswing in China because there are too many headwinds. Zero COVID policies, the deleveraging required, the attack on the tech companies, the continuing trade wars, and so on. So you have to be a little careful in interpreting money, particularly when it's in conjunction with either a credit boom or a credit bust. So let me conclude, because I've spoken for almost an hour now. First of all, I've said that inflation follows from excess money, not from pandemics, supply chain disruptions, changes in terms of trade, or war. Those things affect relative prices, but not the overall level of prices. Central banks in the US, the UK, and the Euro area created excess money in 2020, 2021. And it's that excess money that is currently fueling the inflation. They are raising rates, but the inflation horse bolted already 2 years ago. So raising rates very aggressively, as we're seeing in the Fed, in the US case, runs the risk, as I said earlier, of slamming their foot on the brake too hard, having had their foot too hard earlier on the accelerator. Inflation will only return to target about 2 years after the excess money is eliminated. That is the excess of money balances. And I've indicated that we'll still have, in countries like the United States, an overhang of excess money. The right thing to do, as far as I'm concerned, for the Fed would be to go to the right money growth rate now, that is 5 or 6% per annum, and keep it there, not overdo it on the downside, because that will only exacerbate the impact on asset prices, and then it will probably worsen the recession during 2023. So, as I've indicated here, the main risk is that sharp slowdowns of money will lead to steeper declines in output and bigger increases in unemployment than are required to bring inflation back to target. So the key indicators to watch going forward are broad measures of money, M2 or M3 proxies in the US, M4X in the UK, M3 in the Eurozone, and so on. Not interest rates or the shape of the yield curve, and not monetary conditions indices, and not the size of central banks' balance sheets or the monetary base. Essentially, what I've said is it is money in the hands of the public that counts for spending and inflation, not money on the books of the central bank. And as we've learned in the last decade or so, there is no relationship, or no reliable relationship between the monetary base and broad money. As far as markets are concerned, I think the dollar will remain strong until, as I indicated, the financial markets sense that the Fed is about to ease. We had this false rally in the summer on the misguided idea that the Fed was about to pivot, but it was obvious to people like me that inflation was far from falling. And as we've seen, Powell had to make that speech at Jackson Hole saying that they would persist with tight money until they finally got inflation down. The stock market, I would say, has mainly fallen so far due to expectations of higher interest rates. That is to say, PE ratios have declined. But I don't think that they have discounted yet the declines in earnings per share due to the recession which will occur next year. Indeed, survey organizations like FactSet are still predicting 6% earnings growth in 2023. That's the consensus of US stock market analysts. That, in my view, that's still way too high. Bond yields, I think, will rise further, especially short-term bonds. So the two-year Treasury could well reach 6%. We're at about 4.25%, 4.5% at the moment. And the 10-year could well go to 5%. Because the Fed will become frustrated that the inflation is not coming down, and so they will push harder on the brake. And that will push those longer-term interest rates up as well. Real estate will follow the stock market downwards. And if you want to forecast inflation, my advice is first of all, understand the relationship that I explained between money and nominal GDP. Make your nominal GDP forecast and then split it into a real GDP and inflation component. Now, you can argue with some of the details here. I don't want to be too dogmatic about these forecasts. They're only sort of rough guesses, but the orders of magnitude are roughly right. And you can see that I think that in 2024, across all these countries, inflation will still be above the 2% target. In fact, in the US, I probably underestimated that. I think it may well still be at sort of 4 or 5%. And then we have the lower inflation countries, Japan, China, and Switzerland, where the picture is very different. And with that, I will stop and maybe go back to the beginning and invite your questions and answers, which are going to be moderated by Hongyi. Yes?
Great. Thank you very much, John. Thank you for your insightful analysis. You know, if we believe your analysis, you will make all the economists' job much easier. We'll just look at the money supply instead of all these other shocks to forecast the inflation. We have many questions from the audience, so I'm just pick a few questions for you first. First of all, according to your analysis, you argue the money supply is the key indicator that we should watch for inflation, and then also money supply. You know, to bring down inflation, you have to bring down money supply. So what's your view? Because I look at the last slide, you predicted the U.S. will still have 1 or 2% growth. So you think, with the Fed keep on tightening the monetary condition, there is not going to be a recession. So is recession can be escaped or inevitable?
Well, I have to confess that I did this table a couple of months ago, so I haven't updated it. But since then, we've had 2 sets of money numbers which have been significantly adverse. So the rate of growth of money tightening has been intensifying. And if I did this set of numbers today, I think I'd have probably a negative GDP for 2023 for the US. I mean, it's possible that we get negative growth in the first and second quarter, and then the Fed pivots abruptly in the middle of the year, and we get positive numbers for the third and fourth quarters. So that's why I don't want to be too dogmatic. The Fed could switch abruptly, and you could get those kind of changes. So this is in order to sort of give orders of magnitude. Really, it's not intended to be precise.
Okay, thank you, John. Another question we got is, according to your analysis, like say US, UK, and the Eurozone, they have this high inflation. But is anything related to the fiscal policy instead of purely the monetary policy? Say, for example, in the case of US and then UK, during the COVID period, the government actually gave people a lot of money, just helicopter money, and then sort of the fiscal policy was very loose, so that drives the inflation. But for Eurozone, it could be a little bit different, because Eurozone's inflation really comes most recently. Is it because of the war, the energy price, and the food price? So all these 3 things, you argue, of course, you have there's a common element of market growth.
I understand. I've deliberately hardly mentioned fiscal policy at all, because the only way that fiscal policy is inflationary is if it is financed directly by the printing of money. If a government runs a budget deficit, there are only 3 ways to finance it. You can increase taxes, but for the most part, countries did not do that during COVID. The government can borrow the funds, in which case the private sector will have less funds available to lend. So in both those 2 cases, the government is preempting funds from the private sector and spending them in place of the private sector. Essentially, the multiplier is zero. However, if the money is provided, as in the case of China after 2008, through the banking system, then money is created and you get a simultaneous increase in fiscal expenditure along with an increase in money. And then you scientifically, you can't really distinguish which one is creating the higher spending and the inflation. But in the West, what we had was I would argue, two separate or independent decisions. The central banks adopted QE and created money when they purchased securities from non-banks or when they made loans to banks on condition that the banks made loans to the non-bank public. Both of those two sets of operations put money into the hands of the non-bank public. But the fiscal authorities also made a simultaneous decision to run very large budget deficits and borrow a large amount and use those funds to provide income support to households and firms during COVID. They could have financed that in the markets. You remember I showed you that page where the slide where we had the quotation from Jeremiah Harman, and then how they could have funded their short-term needs in the short-term markets. But the central banks did not buy government securities in the primary market. Central banks were buying existing government debt and existing mortgage-backed securities. So I don't think you can argue that the government printed the money, to fund that debt. The government borrowed the money in the market, which, as I said earlier, is non-inflationary. But there happened to be this decision at the same time by the central banks to increase the quantity of money through QE. Now, there are lots of ways of increasing the quantity of money. They could have lowered the exchange rate drastically. They could have encouraged lending. Often in emerging markets, you see interest rates are subnormal, and that promotes lending, which boosts money growth. So what I was doing in this analysis is to separate clearly monetary growth or monetary factors from fiscal factors. And I believe genuinely that in this case, we had two separate policies operating. We had an expansionary fiscal policy funded through borrowing, but simultaneously we had a highly expansionary monetary policy financed through central bank purchases of securities and central bank lending, mainly those two sources rather than from commercial bank lending.
Thanks, John. So another question we got is, during your presentation, you mentioned about a Plaza Accord.
Yes.
In 1985, there's a Plaza Accord because the U.S. want to promote export. In this time, this cycle, the strong dollar maybe is good for the U.S. to contain inflation. Do you think there will be another Plaza Accord, or U.S. would prefer to have a strong dollar and then just keep it like that until inflation is under control?
Well, first of all, I don't expect something like the Plaza Accord. I was simply using that timing. If you look back, what you'll see is that in the early Reagan years, the dollar was very, very strong. Reagan ran large budget deficits. Money was very tight under Paul Volcker. And the combined effect of that, as we see today, is that a big budget deficit and tight money produces a strong dollar. And I was trying to indicate that at some point, the markets would suddenly switch because the Fed will switch. And when the Fed switches from being tight to easing up, then I think we will see these other currencies strengthen dramatically against the dollar. I I didn't mean to say that we would have a multi-country agreement to intervene in exchange rates. Now, it's true that Japan has recently intervened in the yen-dollar exchange rate, but the intervention has actually had directly contradictory effects with domestic monetary policy. Kuroda's policy is to keep monetary conditions very easy. He doesn't put it in terms of the quantity of money, but keeping the yield curve very flat and very low. Whereas when the Bank of Japan buys yen to support the yen on the instructions of the Ministry of Finance, that withdraws yen from the market and tightens the domestic money markets rather than eases them. So it's ironic that the interventions are producing the opposite effects to what Kuroda would want at the Bank of Japan. But in general terms, no, I didn't mean to say that we will have a Plaza Accord. I just simply meant that after a long period of rise, I wouldn't be surprised if the dollar depreciation was abrupt and sudden when market perceptions of Fed policy switch sometime in 2023 or possibly 2024.
Thank you, John. Another question I got is, for emerging market economies, this time, in this current cycle, the quantitative tightening, we can say the Fed has a lot of impact. So what should this, say currency depreciation is one of the consequences. There could be other consequences such as asset deflation, things like that. So what should the the policymaker or how to handle this this kind of impact from the monetary policy of the Fed?
So the question is, how should emerging markets respond to what the Fed is doing, right?
Yes, thank you.
I would say that they should do exactly what I recommended for the Fed. That is that they should operate an appropriate rate they should generate the appropriate rate of money growth for their economy. That's not going to be the same as the rate of growth of money for the Fed or for the US. It may well be different. For an economy like China, which possibly could grow at a faster rate, or if we let's take a more neutral case like Indonesia, where the economy can grow at about 5 or 6% real, there an appropriate money growth rate is probably about 10 to 12% per annum for low and stable inflation, different from the 5 or 6% that I mentioned for the United States. Now, the currencies will fluctuate, and that will have an effect on export performance and on import prices. But the question is which you prioritize. If you prioritize the overall price level, then the right thing to do is to control money, because that has the longest impact on the overall domestic price level. But if you prioritize certain relative prices or certain sectors like the export sector, then clearly you're going to follow another policy. But I wouldn't recommend that, because pursuing that kind of sectoral objective is normally at the expense of some other sector. And policymakers don't know enough to be able to make that kind of choice wisely.
I see. Thank you, John. So there's still some time. I got a last question for you. From your presentation, you argue the money supply, is a very important instrument for the Fed, not the interest rate. But in the old time, the Fed didn't use money supply because it's very hard to measure money supply, and then also people can switch different money supply like M1, M2, M3 very quickly. So from the practical policy point of view, as a central bank, how would they sort of control the money supply instead of interest rate?
Well, I didn't have time to go into all of that, but I have worked out a very detailed scheme of how to do it. And one of the problems is that people who studied this or looked at it in the US really haven't studied it in enough detail. It is true that Volcker tried to manage money for a short period of time, but first of all, he focused on M1 as the target and non-borrowed reserves as the instrument. That was a mistake. That was a time of significant deregulation and financial innovation, both of which meant that the relationship between M1 and broader money totals was varying quite a lot. And secondly, as I said in my talk at the beginning, it is wrong to focus on narrow definitions of money, M0, M1. M0 is normally money on the books of the central bank. M1 contains checkable deposits, non-interest-bearing deposits plus currency. And if you have interest rate changes, as inevitably you do during a period of tight money, there will be flows between M1 and other money numbers. And as I said again in my talk, the right thing to do is to follow the broadest measure of money, all the deposits in the banking system, because what we're interested in from a portfolio point of view or from a capital markets point of view is money as a part of people's total financial portfolio. And if you just take M1, which people do because of this notion that somehow M1 is important for transactions, you miss an important part of the portfolio reasons for holding money. So it's a mistake, to think that these other definitions are relevant to nominal GDP and inflation. And therefore, that's why I made the argument. Elsewhere, I've made a much bigger statement as to why you should use broad money. And it's only broad money that you should look at in relation to nominal spending. And also you get the best relationship between money and spending by looking at it in that way. So this is part of a much longer analysis, but very briefly, those are some of the considerations why it's a mistake. And as I say, people, it's a kind of knee-jerk reaction. They say, well, Volcker's experiment didn't work. Yes, it didn't work because he had the wrong objectives and he had the wrong instruments. And we had all these changes going on in the money markets. Or they frankly think that there's a rigid relation. They often think there's a rigid relationship between M0 and M2 or M3 or some number like that. I often do not use the official statistics like M2. See, the Fed doesn't care about money, and therefore they define M2 wrongly. Did you know that they exclude all deposits in excess of $99,999? So as soon as the deposit is $100,000 or more, it's not in there, which is absolutely ridiculous. Can you imagine? I mean, a large corporation frequently gets payments of that sort of magnitude and places that money on deposit. So because the Fed and the economists at the Fed have downplayed or have ignored money, they haven't paid adequate attention to the definition of money and the construction of monetary data, which I think is another fault. So we have a long way to go to get US monetary policy back on the right tracks and observing and using these kinds of data. I sometimes put it with my colleague, Steve Hanke, that the Fed needs to have the money supply on its dashboard. Otherwise, it's like a pilot flying blind. It doesn't have a monetary altimeter to tell it, how high or low or how fast or slow money growth is, or how easy monetary conditions are. If you only look at interest rates, you are bound to make the kind of mistakes that the Fed has made in the last 2.5 years.
Great. Thank you very much, John. Thank you. This is a great presentation and a great session. So I thank everybody for joining the webinar today. So the video, the replay of the webinar will be in YouTube. You can always re-watch it or replay the presentation and get more clear. Want to learn more from John. So
Hongyi, could I just interrupt there and say, this presentation will be written up, and if you apply to the HKIMR, you will be able to get a written version of this with all the charts. So it will come with the written explanations, and you can study it more at leisure, not simply on YouTube.
That's great. That's even better. So thank you very much, John. Thank you. This is great. And then for everyone, I want to mention that we are going to have a annual international conference on the Chinese economy on November 23rd. So everybody is welcome to join the conference. Thank you all. Thank you very much. Have a good evening.